Welcome back to Switzer on Sky News Money. The Big Four banks have been under immense political pressure this year, which has rattled the general public's confidence. To assess the bank's performance and to provide his outlook for the year ahead, I'm joined by FN Arena's Rudy Philippek van Dijk. Rudy, welcome to the program.
If only I could spell my name on there. Luckily, you can pronounce it correctly.
I'm good at pronouncing it already. Had a lot of practice. Now, I want to come to the banks, but
Yes.
I think one of the things you've been talking about this week on FN Arena is the difference between the US market, drivers for the US market and the Australian markets. Perhaps we can start there and just get an explanation about what are the differences and what impact is it having on Australian banks?
Well, maybe you can actually make that point since 2012 or so, maybe even before that. It's very much a US-centric bull market that we are seeing in equities. And I know everyone is wearing a different type of glasses, but when I look at the share market locally, I almost see a share market that has to be dragged along by the US,
Kicking and
screaming, almost at times it doesn't even want to. It's almost like the US has to come here and handcuff the Australian share market and drag it along every once in a while. And you see it again in December as well, that the price action in the US it's okay, but locally it's like, oh, we don't want to do this, and it's like there's no direction locally. And that probably signifies as well that the strong earnings growth that the US has and is underpinning their share market uptrend. Of course, we also have the prospect of tax cuts, despite the fact that the Federal Reserve is on a tightening course, but very gradual. Locally, we simply don't have those dynamics. And part of that also is the fact that, yes, we have a different composition in the share market, but I picked up an interesting one this week. If we take all the companies that have offshore earnings in the ASX 200, then that percentage that they represent is about 20%. It's still below the banking sector. And that's the irony, of course, that even if companies locally are being sucked in, so to speak, by things that are happening overseas, they still need the banks to perform as well, because otherwise it becomes a little bit of a half-hearted rally. And that's, I think, exactly what we are seeing. And I think the banks are key in that, because, yes, for example, this year the banks have underperformed the market. But I would make the point that the banks have underperformed the market over the past 5 years. So there's obviously something happening with the banks which is not really happening with the banks overseas. Australian banks this year have so far underperformed their Asian peers by 30%. Now that's a lot. That's really a lot. If Australian banks had rallied by 30%, we would have had a completely different environment here.
Okay, so let's talk about banks, because we've also seen in the US banks have been one of the better performing sector over the last few months.
Again, but not here.
Not here. In fact, Australian banks have gone the other way, and they're sort of looking at tax cuts, probably also deregulatory initiatives, probably a lot of the regional banks. Also higher interest rates potentially helping boost net interest margin.
Not here. See, I always hear people saying that. People say, well, the interest rates go up, it's good for the banks, but not here.
No. Right? So let's come to your outlook for the Australian banks. Given what we're seeing in the US and Europe and Asia, I mean, are those sort of things going to be supportive to the outlook for Australian banks, or are we going to continue to meander here?
I think the best Australian, well, there's two elements to it. The best Australian investors can hope for, if they are overweight in banks or if they have a lot of banks, is that the banks get dragged along with the international banks. I mean, and that doesn't always happen, but at the very least you can make a point now that the banks in Australia are not expensive. And I mean, on a relative sense with the rest of the market. The other element is that the prospects for extra capital returns are there. So investors and analysts are already looking forward that, for example, ANZ Bank might start paying out extra dividends next year, or start buying back their own shares.
But it's been a relative underperformer over the last month or so, right?
Well, they all are.
but versus the other majors, ANZ sort of underperformed a little bit.
It's seen as the weaker one. Cutting the whole theme into short, UBS has made a big change in their view on the banks, and that's quite hot off the press, and I'm pretty certain that that'll be picked up by the media over the next few days. They've basically declared the bank's ex growth today.
But that's not new, is it? I mean, banks have been exposed for...
No. Well, it's new in the sense that we were expecting low growth before,
right.
and now we're basically expecting no growth.
Right.
So there's the difference. I know it doesn't seem like much, but it sort of indicates that if you are overweight in banks, pretty much the only thing you can now count on is that they will keep their dividends, which pretty much everyone expects, and then maybe get some extras because like the likes of ANZ might pay some extra out or buy some shares in. And then maybe you can hope that if the banks rally in the US and in Europe, that sort of the international investors go, you know what, buy some Australian banks as well. But in the bigger sense, in the bigger sense, I've said this before, some sectors in the Australian share market are basically in a bear market phase. Right? You can make that argument that Australian banks, relative to their own history and relative to their peers, are in a bear market phase. I mean, there's nothing happening. If you look at the price chart over the past 5 years, it's going sideways. Yeah? Now, the sideways pattern, some might argue, that's not too bad, considering that Telstra went from here to there. That's a lot better for it. But it's also not a fantastic phase. Yeah? Like you have your dividends, you get your franking, you get your short-term rallies that don't really stay there. But if you buy cheap enough, you might have a little bit of capital appreciation. But at the end of the day, there are large parts of the share market that perform much better. And that's maybe where the real question comes in.
But don't the banks have a fantastic opportunity to take out costs still? I mean, they've really only played around the edges of cutting costs, haven't they?
Well, they already are on that, and they have been on a few years already. See, that's already coming through. What the banks are now in the phase is they're basically selling assets now, and that's where obviously the prospect comes from. But
that was to generate capital, right? I mean,
not only. That's part of that. But for example, it's also reducing their risk profile as well.
Sure.
I mean, and that's where investors should ask questions as well. The fact that they're getting rid of their life insurance, that's not to give the money to charities. Yeah, there's the reason there. Right? The reason that why pretty much everyone is getting out of life insurance means there's trouble around the corner, and it's happening in a few years' time. But also the fact that they're getting out of wealth management might also raise a few questions, and they're all basically getting out of wealth management.
Well, I'm not going to turn you around on this one. What impact of the Royal Commission? Is that still a negative on banks?
It is.
Or do you think the market will just get tired with it?
No. I think it is because I'm suspecting, as is my idea, that the Royal Commission might uncover a few things that we haven't thought about right now, and that will always be a negative. I mean, given the bank's history and in particular recent history of generating scandals by themselves without a commission, I would be willing to bet that with the commission they probably will find a few things. Okay.
Well, I'm in the minority. I think they can cut a lot of the costs on the cost side, but anyhow, we'll see how that plays out. I think obviously the challenges are around growth. There's almost no volume growth. It's hard to shrink to greatness. And
exactly. I think anything that happens is defensive. Yeah. I mean, there's no leap in growth going forward. And what I pick up from the analysts is that they're now not looking 1 year ahead. They're now talking between now and 2020.
Let's move on to just a bit back to the market. Any sort of highlights from an upgrade, downgrade point of view this week that stood out for you in terms of broker assessments?
Well, here's the thing, this is a few fund managers which I spoke to recently that had the same observation. Most of the stocks that performed really well this year, they're finding they're going tougher. So obviously fund managers are taking profits out of stocks that perform really well.
Like CSL, like Cochlear, like some real REA, those sort of stocks.
Exactly. Yep. The laggards all of a sudden start rallying. Well, that indicates where the money's going. I mean, all of a sudden Telstra is a star stock. I mean, that of course is not going to last forever and ever. I mean, and I'm particularly interested myself, and I would implore everyone. See, usually people respond to falling share prices and then think like, oh, there's a bargain at hand. For example, Retail Food Group. I don't think that's a bargain, even though it has fallen a lot. My style of investing is I'm following very good companies, and I have a list, And whenever they start going south, then I get interested because I know they're very good companies. So not, of course, some.
Okay, let's talk about some very good companies.
Yes.
I think this is in the category Aristocrat Leisure.
Yes, definitely.
So what did you want to say about Aristocrat Leisure?
Well, the market is getting a little bit anxious because of a big acquisition they just announced. If they hadn't announced that acquisition, I think few would have doubted that this would have been a big rally because their result was absolutely fantastic.
Sure. Yep.
And as expected. Now, people are now getting a little bit cautious because big acquisition, you don't know, it's 1.4 billion. Yeah? I think, given the legacy that Aristocrat is now building up and the momentum that's operationally there, I think this is a buying opportunity.
Okay.
But although you might have to wait a little bit because the market can remain skeptical for longer than we think.
Yeah, and then that will be a while before they digest that. And
yes.
But so
early in the year, something similar happened with Link Administration.
Yep.
Big acquisition.
Yep.
For a while, nothing. Rally afterwards.
Okay. So Aristocrat Leisure now Xero, which of course has had an interesting history, but been a real growth stock, and then got up to $40. The market took all the way back to $10, I think, or thereabouts.
Yes.
Now you.
And it went back.
Yep.
Well, here's the thing. Xero is probably also one of those prime, upcoming, emerging growth stories in Australia. Well, it's actually New Zealand, but it will become Australia now. Now the irony is that New Zealand fund managers will have to sell that stock because it's moving to Australia, which now has shaved off $5 of the share price already. Might actually go further, we don't know, because it's a quiet period. Now again, this is a situation that has nothing to do with the company or with his operation. So I think those things really generate buying opportunities. Another one, for example, which I'm keeping close eye on, would be A2 Milk. Because A2 Milk is going to move into the ASX 100, which probably means small cap fund managers will have to sell the stock. Something to watch as well. See, those things are great opportunities because there's nothing wrong with the company, and definitely nothing wrong with the operation.
Okay, so we're going to write down Aristocrat Leisure, Xero and A2 Milk. And as always,
fantastic.
Rudy, we're out of time, but I know you could go on we could talk for hours about this, but three things to look at. So Rudy Philippek van Dijk, the editor of FN Arena, thanks for joining us on Switzer.
My pleasure.
After the break, we'll explore what's driving Sir Frank Lowy and Rupert Murdoch with their latest corporate deals with Phil Baker.